Today we're going to present on Warren Buffett. It's a TED talk I gave a while back, and it's always better to stand at these things, but we just wanted to present this in a video format so that a larger audience could see it. Called it Baffled by Buffett. This is a guy that really started investing at 11 years old, and he's a strange man. I mean, he spent 50 years at exactly the same desk. He's conservative, but we know he's brilliant, and he says some incredibly interesting things. We really want to test some of those quotes today in this presentation relative to his data. Called it Baffled by Buffett, and just a little on us. Northstar has over 10 billion of assets with our BE partner. We've got a lot of analysts and portfolio managers, 12, so that's a significant team covering SA equities, fixed income in South Africa and abroad, and then global equities. I've been in the industry my 30th year this year. I've been a portfolio manager for 26 of those years, and I'm the lead manager for the Northstar Global Flexible Fund. So why is Buffett relevant? Well, we know, he's delivered outstanding performance. We compare him to the S&P over time. It's phenomenal. And but it's not just that. Unfortunately, the competition has been terrible. And we look at the last 20 years as a snapshot for active versus passive. And 65% of managers underperform the S&P 500, 35% outperform. The last time more than 50% of managers beat the market was in 2009. And only 3 years in this data set of about 20 where the managers, more than 50% of managers beat the index. We must say, though, that this is a particularly tough time period. And if you look back over history, active goes through phases of outperformance, and then passive goes through phases of outperformance. So it's unfair to label active ghastly, which is totally, you see this all the time, this vernacular. It's not really built out of fact if you look over long-term data. Getting back to Buffett, how often does Buffett win? So just looking at one of his quotes, no matter how great the talent or efforts, some things just take time, he says, using that point of time. You can't produce a baby in 1 month by getting 9 women pregnant. So Buffett, over this 20-odd year period, has beaten the market 55% of the time. And when we looked at his data over longer periods of time, 54% hit rate over 50 years. So very, very good. If we compare that to us, Northstar, we've been around for 30 years in the market, but really at Northstar for the last 13. So we're going through our second investment cycle. If you think of cycles that are 5 to 10 years, we really are moving through our second one. So this is good data. We believe that anything shorter than 3 years is effectively luck. And Northstar is beating the market 58% of the time. 7 of the last 12 years have been running global money here. In terms of beating the Buffett portfolio, we've done it 6 years from 2013. So certainly, right up there, very good performance. And from a line chart perspective, we've outperformed him too. And again, we're not trying to say this from a place of arrogance. We just rate him so highly that we always think about Buffett being in the room. How would we feel about what we do? And we set the standard simply because the active industry has struggled. So more importantly, how do we do it? And we believe that the genius doesn't lie in the manager, it lies in the structure. So all about, for us, the repetitive nature of what we do leads to success. So we have a buy list, there's always 100 companies on it, they're always up to date. And how does a stock make it onto the buy list? Well, really 2 areas, and we don't have a lot of time to explain it, so we'll be quite brief, but we risk score every company. And that's looking at moat, management, ESG, and the industry. So each one of these, we score out of 25, and a company has to get above 50 out of 100 to make it onto our buy list. Now, that looks simple, but we put out a full report, and we're going into great detail to understand each one of these various factors that drive our decision whether we're going to own something or not. So that risk score is all around how much of something we can own. On the right-hand side, it's when we can own it and when we should sell it. That's around valuing it. So we build valuation models on every company. We try and understand what we believe they're worth through the cycle. And we believe we're very good at this if you look at our hit rates in our portfolio. So it's, how much we should own of something and then at what price we should buy it at. And really it comes down to creating risk buckets and they're weighting buckets telling us, what kind of exposure we should have to different stocks. So high-risk stocks, less than 2%, low-risk stocks that have made it through that quality framework, you can have up to 8% exposure. And that buy list in a nutshell is represented here. So a lot of data. I mean, we don't have to move away from the buy list to know what we do. Everyone works on this buy list. So we just gave a 2024 April example of our buy list. It's changed dramatically since then. But there's a lot of information on this buy list that drives us. One of the things we can do with the buy list is we can plot how cheap or expensive it is daily, which is what we do. So if we know what one stock is worth and we've got 100 stocks on there, we should know how much upside there is on all 100 at any point in time. That allows us to draw a graph. So we can see that when the buy list operates in the red zone, there's not much upside. When it's in the green zone, there's a lot of upside. And this again now flows into asset allocation. Because we're doing the work, we then know when to buy our buy list actively and push our equity weightings up in our portfolios, and when to sell the buy list down and reduce our equity exposure when we're in the red, when the upside is low. Getting back to Buffett, when does Buffett win? And again, one of these great quotes, price is what you pay, value is what you get. So when does Buffett do well? Well, he does well in times of crisis, the 1974 oil crisis, the dot-com crisis, the 2008 GFC when financials were overvalued, and the rising inflation crisis that took place in 2022 post-COVID. So he outperforms the market when things are going badly in the world. He's very good at capitalizing on those moments when people are fearful. But what's equally interesting is because he sees value and he focuses on value, not on price, he also tends to struggle when the market goes into euphoric stages and it's completely overvalued. So the dot-com boom of 1999, he struggled. The 2009 GFC rally, where financials became so expensive, he struggled. The COVID rally coming out of it in 2021 was a tough time for him. And the AI boom 2023. Those are the times when his portfolio underperforms simply because he refuses to take the risk that the market's exposing investors to, in his opinion, overvaluation. If we look at it from the perspective of when he outperforms from PE levels of the market, in green, when the market's P is low, like below 10, Buffett does incredibly well. When the P is between 10 and 15 in orange, he still generates high returns. But once that P starts going 15 to 20, he starts to perform more or less in line with the market. And as soon as the market gets expensive, he underperforms because he refuses to partake in expensive markets. And his stocks that he tries to hold are generally cheaper stocks. And if we do the same thing from the perspective of performance in the market, if the market's giving negative returns below zero, Buffett tends to beat the market. When the returns in the market are between 0 and 15%, he does well. But as soon as the market starts generating returns well above 15%, it's in those kind of blowout phases, he starts to underperform. Interestingly enough, Northstar is no different. When the market's giving negative returns, we beat it. When it's doing between 0 and 15, we beat it. But as soon as the market starts becoming extremely expensive and rallying very hard, our portfolio starts to struggle. Back to Buffett again. What does he say about trading? Calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. Now, if we look at Buffett's holding period of stocks, what's interesting is the last decade, he's had 130 stocks. A lot of them are only held for 2 years. And in fact, most of them are only held, only 10 were held through the full 10-year period. So in fact, Berkshire tends to hold stocks, top left-hand side, through the full tenure that he's been managing money. He tends to hold stocks about 5.4 years on average. That's how long he holds on to something. But since 2017, and we use that data because that's when we started launching a dollar fund offshore in direct competition to all the dollar managers, there are 280 of them, offshore managers. Buffett's tended to hold stocks for only 4 years. So he holds a stock on average. His holding period for a company is 4 years. If we look at that compared to Northstar, it's 4.2 years. Uncannily similar. What's interesting about our portfolio, though, is that we tend to stay in the same companies and sell out of them and buy them back again. We're so focused on those 100 stocks. We know exactly when to own them. We're screening 2,500 companies. We focused on a shorter list of 250, and we're obsessed with 100 stocks at any point in time. So what we can show on this slide is that in 2017, 60% of the companies we held in 2017, we still hold in the portfolio in 2024, although we might have sold out of them through that period and bought them back. And in fact, this slide shows us the difference in blue between our portfolio without trading and in red with trading. And what's fascinating is we add 2.2% of alpha a year by trading out of expensive things and buying the cheaper stocks in our portfolio. Getting back to Buffett again on diversification. So he says diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Well, is Buffett really, is this a sleight of hand again? So we again went to his data. What does Buffett's data tell us? It tells us that he owns 3 asset classes most of the time: cash, fixed interest, and equities. And we also know that at times he has 80% in equity and other times he has 80% in fixed income. And he tends to own all of them most of the time. So it's not really true that Buffett isn't diversifying his portfolio. He most definitely is. If we look at the Northstar's global fund, what's very clear is we also diversify across multiple asset classes. We bring new asset classes in, we sell out of them. We're doing that work. And how do we know when to buy something? Because we have such a powerful framework. 3 teams, a South African equity team, a global equity team, and a fixed income global and local fixed income team, giving us data on the expected returns of their underlying asset classes each month, then goes into an optimizer that we run that allows us to know where to position the portfolios, where to have the biggest weights and where to have the smallest weights. I'm going to conclude with some performance data, which I think is interesting. We called this part of the presentation 102,705 plus one reason to own the Northstar Global Flexible Fund, the fund that we offer in the global space. Now, I want to make the point that there are 280 global managers competing with us, not South African managers, global managers. And those are big branded managers competing with Northstar Asset Management, who operates from Cape Town, South Africa. The first graph is highly instructive because what we show is those 280 managers out there in blue compared to our red line, our performance in that global flexible sector. And it's clear. There's just no debating that a South African manager that knows what they're doing can beat the biggest and best managers in the world. And we're doing it consistently. That's the second point. What we show here are different time periods. So instead of looking at a graph straight from the beginning and saying we beat them, let's go look at the inception. 8 years ago, 7 years, 5 years, 3 years, 1 year. We're in red and the peer group is in blue. And it's very clear that over every single period, we've beaten that peer group. And in fact, what it also shows us, if there are 100 students in the class, only over 3 years were we 33rd best performing student. Most of the time, we're in the top 10 students, top 20 students in that class. That's showing you the percentile ranking. It is incredibly consistent and well outperforming the global peers. South African managers know how to manage global money. Now, I'm going to conclude with that last one reason why you as an advisor or private client should look at Northstar to consider us in your basket of managers. And it's for this reason that's a very powerful one. What we show here is a peer, a competitor of ours in South Africa with an $8 billion fund. They're in orange, mustard, and we're in red. And what's clear is the performance of these two funds are exactly the same. But our fund is $103 million, not $8 billion. What is the difference between these two managers? Because it's clearly not performance. Well, it's brand and its distribution. The manager has the benefit of having a huge brand and a massive distribution sales force that allowed them to build an enormous asset base. And we say again, we hold them in the highest regard. But the point really is that your client doesn't retire on their brand. That's their benefit. Your client needs to retire on investment performance. And here's my last comment, really. What's interesting about this slide is what we've shown you is in red is our global flexible fund, which is only 65% in equity, against in a raging bull market, against a manager in orange, that's their equity fund. If we superimpose our equity performance against that in blue, you can see how we've dealt with that manager in terms of performance over a long period of time. Look at Northstar seriously. We're right here. We know what we're doing. This is a space we enjoy. We love managing global money. We do it with a highly structured, repeatable process that has generated world-beating returns. Thank you. We hope you enjoy the presentation.